Welcome to Your Money Guides, brought to you by Interface Financial Planning. Hello. In this episode, I want to talk to you about what you should do when asset values are falling. The reality is that asset prices will go up and down over time. Indeed, we should want prices to go down some of the time. Falls in asset prices and values are to be expected as part of the longer-term journey. For the purpose of this guide, I will focus on and define assets as investments which are purchased and held with an expectation that the asset will provide income or will be later sold at a higher price for a profit. The investment and asset sectors I will focus on are fixed interest, such as corporate bonds and government bonds, both in the UK and overseas. Equities, basically shares in companies in the UK and overseas, both small and large companies. Property, this includes residential and commercial properties, both in the UK and overseas. And finally, commodities, for example oil, gold and copper. Investment assets present a difficulty for many investors because there is often a physiological factor involved which is quite distinct from most people's normal experience. In most other areas, we are delighted when prices fall. Take fuel prices at the pump. We feel good when we see the prices falling and bad when we see them rising. In shops we hunt for bargains and like it when we see the prices of our favourite items lower than normal. We are conditioned to enjoy lower prices, although this gets challenged when we invest or hold an asset. If our asset price falls, we can easily get unnerved, worry about it and wonder where this is taking us. This shows up most commonly with investments into shares, which tend to move up and down more rapidly than property and sharper in both directions than fixed interest investments. Commodities, on the other hand, are like shares. Their price also tends to fluctuate with significance. The gut reaction of many private investors is to sell their shares quickly in a falling market to avoid incurring further losses. However, this is often the worst thing one can do. So let's look at some reasons why not to sell in haste. Historically, falls in share prices, even significant falls caused by stock market crashes, level out over time. For example, the FTSE All-Share Index was back to the level it had reached before the crash of October 1987 within 2 years, and had more than doubled its pre-crash value within 10 years. Also, long-term strategies and investment decisions should cope with falling markets, as the likely reason for falls is a lack of confidence among investors, not a fundamental problem with an investment or fund or company. Next, losses change from paper losses to realised losses only when you sell your shares. If the sale occurs after a rapid fall or when prices are low, history shows that this is always the worst time to cash in, as prices tend to recover and a better time to sell at a higher price will arrive. And finally, panic selling has a knock-on and potentially self-perpetuating effect. If investors as a group can work through the down periods, there is less likely to be widespread carnage and prices can revert to a more reasonable level. Although these aspects are cited as relevant to the more volatile areas such as stock markets and shares, the principles span all asset areas. The proven investment method is to use an active and well-structured asset allocation approach. The approach is simple in theory and not much more complicated in practice. The theory is based on the understanding that different asset areas perform in different ways at different times, so when one asset area or sector is doing badly, another is doing well. If you can balance between the asset areas in a way which works for your attitude to investment risk, you can smooth out the overall fluctuations to reduce your risk, which is another way of stating to control your losses. This asset allocation approach should be active to be truly successful in the longer term. It's crucial to explain what this means, as the word active can be used in other contexts. Active in this context really means dynamic and must be understood as attached to the words asset allocation. I'm therefore describing active asset allocation and dynamic asset allocation. This means that you follow basic principles of an asset allocation and you rebalance regularly. Rebalancing makes this approach active. So how does rebalancing work? It's the regular adjustments you make to your portfolio to keep the mix of assets in line with your attitude to investment risk over time. It may also consider wider economic movements, but it's mostly about the portfolio shifting because of performance. Rebalancing is the process of regularly moving the assets back towards their optimum position as required. This is a way of disciplining the approach to sell bits from those areas that have done relatively well and topping up those areas that have done relatively poorly, which increases the prospect of buying low and selling high. It helps to keep the risk level managed and produces in the longer term an inbuilt discipline to the investment structure. Therefore, investors who use this approach tend to feel more relaxed when asset areas are falling, as they know that sooner or later they will rebalance, and this could help with better long-term returns. I now want to talk about emotional and behavioural considerations. This subject is probably worthy of its own guide. However, to summarise a little here, the science behind emotional and behavioural finance has started to reveal how important these are in the approach to money management and investing. We all tend to react in certain ways to certain events, and make decisions driven more by our emotions than we would probably realise. Examples abound, but in terms of market falls, investors can become gloomy or panic and start to behave differently. This can include making irrational decisions to sell, often at the worst possible point, or even more significantly, suddenly believe they can sell and then buy back at a better time. On this latter point, the evidence is clear and consistent it doesn't work. Rarely do investors react when their portfolio value or part of it is falling, nor do they welcome this. Yet rationally, if such an event is normal and to be expected, then what difference does it make? The biggest challenge with investing tends to be the longer-term aspect. Measurements must be made and the results judged over long periods. In the moment, this can be difficult to maintain. Even 2 years seems like a long time when markets are falling, yet in investment terms, 2 years is a short term. Rational investors realise this and will simply accept the downtimes as normal periods that are inevitable. More than this, they will see this as an opportunity to keep a close eye and when the time is right, rebalance for their longer-term benefit. So in conclusion, it's not easy being a rational investor. The emotional angle I've just mentioned is a natural one, as we all want to enjoy our lives and avoid difficulties. When investing values are falling, we can easily allow our minds to project into the future and foresee difficult or uncomfortable outcomes. The iron discipline and unemotional characteristics of a professional investor are difficult to learn or absorb. However, there is likely to be much less stress and, in practical terms, a better outcome by adopting this approach. Rationally, it's wise to expect and then relax about asset price or market falls. If the basic investment position you have chosen is built upon strong foundations, then there is no reason to worry, panic, or leap into action. There should always be regular reviews, and it might be if a prolonged or unexpected fall occurs, a review is made to explore how this affects any plans, and possibly if this gives rise to any fresh opportunities. The history of asset markets and price movements in those markets show that they fluctuate, and there has always been periods when prices have fallen. These are part of the normal cycles and should pose no threat to any investor, provided the investor has a well-structured risk position and their investment portfolio is part of a robust financial plan. Thank you for listening. For more information, visit our website at interfacefinancialplanning.co.uk.